Welcome to part 2 of Module 2. Having learned about the basics of shares, the stock market and the market indices in part 1, it's now time to look at 2 contrasting strategies for putting your money to work in markets. Active investing and passive investing. Active investing involves frequent trading, and generally investors have a goal of beating average index returns. However, it requires a high level of market analysis and expertise as well as time. You can do active investing yourself, or you can outsource it to professionals through managed and mutual funds. Passive investing, on the other hand, is best described as a hands-off approach, with a focus on buying and holding assets for the long term through ups and downs, and with a long-term goal in mind, such as retirement. Investors look to replicate the performance of an index or a market. What's more, it doesn't require daily attention, which can be attractive to those who are time poor. Warren Buffett, one of the best-known investors in the world, with a current net worth of $119 billion US, is a big fan of passive investing. Proof that you don't need to devote all your time to investing to see great results. But as ever, it's important to select the strategy that best suits you and your financial goals. I want to spend a little time on stock prices. Stock prices generally fluctuate every day. Why is that? Well, the main reason is supply and demand. If more people want to buy a stock rather than sell it, the price goes up. But if there is a lot of the supply, the price will go down. Some stocks are more popular than others. If investors believe a company is doing very well and is on course to make great earnings, their stock is in high demand. And if people believe a company is not doing so well due to falling sales, they look to sell their shares in that company. Investor sentiment and expectations have a huge effect on a company's stock price. That's why companies must be very clear in their updates to investors about what their plans are to grow the company. Showing strong leadership and direction is important to shareholders. However, sometimes consumer trends change and a product you once couldn't keep in stock is no longer in favour. In December 2021, when one of the main characters in the Sex and the City spin-off, And Just Like That, died after taking a Peloton bike class, Peloton stock plummeted by 11.3%. Was this as a direct result of the TV show? It's hard to say, as Peloton sales had been slowing after a pandemic boom, but it certainly didn't help that their products were being portrayed as life-threatening. Thus, investors decided to offload the stock from their portfolios. Moving on, let's focus our attention on stock market sectors and why one might be preferred over the other as a passive or active investor. As you already know, stocks are generally considered to have a higher degree of risk compared to some of the other financial instruments, as the value of the equity or share is tied to how well the company is doing in the stock market. Within equities, there are defensive sectors and cyclical sectors. Cyclical sectors are made up of companies that provide goods and services where demand is greatly influenced by the ebbs and flows of the business cycle. In a recession, a cyclical stock will typically go down more than the rest of the market as people try to cut back on unnecessary expenses. Sectors that are typically considered cyclicals are materials, industrials, consumer discretionary, financial services and energy. If you're an active investor, you might like to research more about cyclical sectors. Defensive. By contrast, defensive category, which is made up of consumer staples, healthcare and utilities, perform well during recessions. These sectors consist of companies that make products or services that consumers always need and in the same quantities, even in times of an economic slowdown. That is, companies that make essential products. However, it's worth remembering that sectors classifications are not perfect guides. Companies selling luxury goods often do well during recessions, like they did during the pandemic. In a difficult economic climate, a portfolio biased to defensive stocks with more consistent and stable earnings should perform well. But as you know, market shocks can occur. So it's important to diversify your investments, which means investing in a variety of asset classes and a variety of assets within those asset classes too. After all, a well-diversified portfolio helps to protect your investments. And it also helps you achieve the most returns in the long term. And consequently, helps you achieve your investment goals. As always, it's important to remember that the value of your investment may go down as well as up, and you may lose some or all of the money you put in. That's it on stocks for now. We'll learn more about how to pick your first stocks and evaluating companies in Module 3. But before that, my colleague Elizabeth Gagan is going to help us understand the world of fixed income and bonds. Thank you, and good luck with part 3.